Brady, welcome back. We do have some unfortunate things to cover today in the DeFi space. There was an exploit of a platform that I recently covered, Sirio. It's a lending and borrowing platform in the Hedera ecosystem. And just to start, it seems like it was an exploit. We're going to get into some more details in a little bit, but on a high level, I do want to give my condolences to anybody that has appeared to have lost funds in this. That's table stakes in here. It is very difficult to go through and participate in the DeFi ecosystem and not have issues. I've been taken advantage of with different things. I've gotten caught up in things where there's been lost funds and things like that. But it doesn't make it any less frustrated and any less difficult when it happens to you. I also want to say that all the teams that are working hard to try to understand this and resolve this, we appreciate that, including the Sirio team. And I also want to talk to the people that did the exploit themselves. There's a fine line between somebody who's a white hat hacker, and I know this was an exploit, not a hack, but and a black hat, right? The bad guys and the good guys. And it really depends on how they respond after this. There are situations where to draw attention to something like this, a vulnerability on a platform, a white hacker will go out and actually take advantage of the exploit, but then gives the funds back. And even if that was, in this case, their intention to start, or it wasn't, you can change that right now. You can go from being a bad actor that have the authorities trying to track you down and things along those lines, to somebody who is helping make our ecosystem better and being one of the good guys. But Brady, before we get into some of the details, is there anything on a high level that you'd like to discuss?
Yeah, no, I think that was well said. It's always unfortunate when any kind of hack scam issue happens in the ecosystem. It impacts morale, it impacts retail users, the ecosystem as a whole, other protocols, the foundation organizations, and Hedera itself that are trying to create a safe environment for DeFi and these other sort of native Web3 ecosystems to exist on the network. And so condolences to the team that's working through trying to figure out the challenges here, and also to any of the retail users that are participating in this. Everybody's taking risk. The risk is inherent to the people building, the people using these tools, the network itself, the foundations for supporting accelerators. There's a lot of risk that gets thrown around, and everybody sort of inherits that. And so hoping just for the best outcomes for everyone, and yeah, condolences to the team as well.
Yeah, so to everybody out there, just hang in there. And to the people that might have done that exploit, go ahead and put that white hat on. And if you can, return those funds and get on the good side of things. But Brady, let's get more into the specifics here as far as you understand it. I appreciate you coming on today because I know you've been pretty much up all night because you are neck deep in the DeFi ecosystem. From your understanding, what's happened here?
Yeah, so we, the Sirio team obviously was digging into trying to understand exactly what happened. It's their code base. There were audits that were performed on the contracts. This exploit took place, and they've been working hard to try and figure out the specifics of it. It's hard on our end to know what those specifics are. We don't have access to a lot of different things, but we do have access to on-chain data and transaction information. And so, what we did is tried to understand at a high level what the order of operations was that took place, where this stuff stemmed from. And, from what we could tell at a high level, at the starting point, there is a functionality within Bonzo Finance that allows for utilization of what's called a flash loan. And a flash loan is effectively the ability to, in a single atomic transaction, borrow funds from Bonzo and utilize those funds for things like arbitrage between decentralized exchanges, or what's heavily being used for flash loans is the ability to perform liquidations on Bonzo. So liquidation bots will utilize a flash loan to swap assets and cover the debt that is bad for users and take collateral. And that's a really healthy activity that allows for creditors to remain healthy and whole and the protocol to continue to operate. And flash loans are a really good thing. What flash loans do have the propensity to do in an ecosystem is amplify problems that sometimes already exist. So if there are things like an exploit in a smart contract that can be targeted, it's often found that when you have a lot of capital to use that you aim at these exploits, then you can sort of amplify the activity itself. So the user could be holding a lot of funds anyway and attack that exploit, or they could take out a flash loan and target an exploit using the large amounts of funds. And in order for a flash loan to operate, you actually create a contract in order to do that. And so these contracts can be quite complex, where they can contain tens, 50, 100 child transactions within them. And effectively what happens is the funds are borrowed. They're used in these different ways depending on how the contract is configured. There's sort of an order of operations that it goes through. And then by the end of the contract, it pays the loan back to the protocol. And it does all of this in a single, what's called atomic transaction, which means that if it isn't able to pay the loan back at the end, the whole series actually reverts. And so it's actually a really novel and impressive way of being able to safely borrow large amounts of capital for various purposes. But yes, if there's vulnerabilities that exist, then it is a lot of capital to be able to use for both good or bad things. And so what we saw is a flash loan. There was 3 attacks. Each of them used sort of the same template, and a flash loan was taken out. There were a series of transactions that took place where certain funds were deposited into Sirio in a specific order, and then we don't know for certain yet, but there was a couple indications in those sets of transactions showing tiny decimal point transactions. And when you see tiny decimal point transactions like that, sometimes that's indicative of a vulnerability around the way that that the math in the transaction is used. And again, I'm speculating here. I'm definitely not the one that should be explaining, specifically what it is that went wrong. We do look to the Sirio team for
This is just a first hot take, right?
impression, yeah, and so they'll have, as they continue to do their due diligence and work with their auditors and forensics to figure out specifically what happened. We'll learn more over time, and I think to some of your points earlier, we'll learn from this, and I think it's going to harden the DeFi ecosystem. It's going to harden all protocols on Hedera. It's going to get us better, I think, at obviously recognizing the importance of security, but taking all extra steps, pulling out all the stops for ensuring that we continue to try and remain as safe as possible. But yeah, that's sort of what we've discovered is these three transactions. They start with a flash loan, and then it results in an exploit that allows the attacker to steal funds from the liquidity pool, essentially tricking the liquidity pool into thinking that there's more collateral that's been provided than there actually was.
Okay, understood. So I do want to get into just kind of some of the risks in general. Of course, when we're talking about DeFi, there's a fair amount of risks. There's the normal market risk. Whenever you're dealing with anything in crypto, there is platform risk. So things that could go wrong with Hedera or one of the platforms. Those are rare, but it certainly can happen. And then there's smart contract risk, which it looks like this would be in that realm is smart contract risk issues. There is a few ways you can help control that. You can use battle hardened code that has been around for a while, and you can certainly talk about that. You can have it audited. Now, Sirio did have it audited, but it was kind of brand new code in this case. And then the other controls are just practical controls that you can put in place around participating in DeFi. So when you have a new platform like this, use small amounts, right? Don't start off with just putting your entire crypto position in there. I actually think, especially for people who have larger Hedera positions, I think that a DeFi portfolio should be thought of kind of like it's an options portfolio. It shouldn't be a huge chunk of your overall position, maybe up to 20%, and only 20% if you're really into DeFi and you really understand exactly what's going on. And that 20% could be divided into all kinds of different things, doing things, around lending and borrowing, doing things, providing liquidity, and split up so you don't have all your eggs in one basket. But Brady, around the risks here and different controls we can put in place, what are your thoughts?
Yeah, totally agreed with sort of the thinking around how you diversify risk. I mean, any investor in general, I think, is going to be thinking about risk in that way. It's how do I not put all my eggs in one basket? And DeFi as a category in which you're allocating a certain percentage is probably a safe way to be thinking about it. And then even, like you said, within DeFi, separating that out to different protocols. Um, I think there's a way of looking at this through a lens of wanting to create novel and new innovation that pushes the envelope, and at the same time looking to try and do things, as you said, with sort of battle tested hardened code when you're able to do that. The benefits of the novel approach is you're trying to build something that's a bit new, that it has different types of functionalities that aren't seen. And ultimately, like, one of the ways that I think Hedera's ecosystem on the retail side could potentially grow is we do need something that is novel and new, not just for the Hedera ecosystem, but for all of Web3, because those types of applications end up attracting lots of retail users if they hit the nail on the head with something that's unique. And I argue, like, Polymarket, for example, on Polygon was like, that was a big novel new thing that really helped put Polygon on the map. And I do think Hedera needs something like that. And when you start to push the envelope like that, you do get into these novel types of contracts that maybe are potentially have less security. And I think in this case, I definitely saw Sirio trying to bring novel things to market. There's things around AI that they're pushing. There's wanting to have some level of uniqueness with their code base and their protocol, and I think that's great. I think the approach that we tried to take was slightly different, where we're more boring in a
Well,
sense.
Brady, before you dive into the differences with Bonzo, you guys have been going above and beyond to try to support Sirio, but I don't think there's any problem with you explaining what the differences are, because they're both lending and borrowing platforms, and even though there, of course, are risks associated with Bonzo as well, I do think it makes sense for you to explain why it's different from Sirio and maybe why there's some other controls in place.
Yeah, that's a good way to phrase it. So the approach was we wanted to utilize something that's been tried and true across other networks for a long time, other ecosystems. It's been battle tested technically and economically. And we looked at the landscape and we saw, Aave is such a market leader in the space. And in particular, the Aave V2 code base, it's open source. It's been around for quite a long time. Aave is actually on V3 now. And so we forked and utilized Aave V2's code base at the heart of Bonzo. And kind of the way that we thought about the approach is we wanted to modify as little as possible as part of this. Obviously, Aave had gone through audits with those contracts. There's been many white hats looking at that code base to battle test it. It's been in existence for a long time. There's economic aspects of it and technical aspects that have been sort of through the ringer just throughout time. It's also been adapted to other EVM networks as well. As we know, Hedera has EVM capabilities, but anytime you sort of add the EVM to different networks, oftentimes there's like small nuances and differences. And so, our whole approach was use Aave V2 as a base, try to modify as little as possible, and just adapt the things that we need to adapt that are necessary for it to function on Hedera. And then, obviously from there, go through smart contract audits with, we chose Halborn as our smart contract audit provider. They have a bunch of experience both with Hedera protocols and the Hedera network itself. but then also just DeFi protocols in general, and went through that process. And then we've been so paranoid about risk from the beginning. Lending itself as a category is probably one of the most risky types of protocols out there, and that's risk for the protocol itself, the users, the ecosystem. Again, when you're allowing people to borrow large amounts of capital for use, there's a lot of risk involved in that. And so we took the approach of ensuring that as we grow over time, those parameters, there's a number of parameters that you can configure for risk. And we started very conservatively. Loan to value ratios, for example, were set very small, very tight, especially at first. We have supply caps and borrow caps that we had set up. There's liquidation thresholds. So beyond the loan to value ratio, a liquidation threshold is essentially a buffer between the maximum amount that you can borrow against what you've supplied to when you actually can get liquidated based on asset price fluctuations. And part of this was utilizing LedgerWorks, who's been a great partner for us, who essentially ingests in real time ecosystem data, so like pools from Saucer Swap. It ingests asset risk data, so like normalized volatility of assets, the number of holders of assets. There's a whole bunch of different things related to the risk of an asset. So it pulls in that information, and then it pulls in macroeconomic data as well. And it models all of this in real time and generates a report every day that essentially gives a range for the configurable parameters within Bonzo Finance that it has deemed as a safe range. And typically we're on the more conservative end of that range as well, even. And so, we're constantly looking at that and receiving recommendations and doing these updates. And on a long timeline, actually, it's the DAO for the Bonzo protocol that's going to be voting on the changes to these different risk parameters. And obviously, there's going to be a lot of information that's provided to governance token holders to be able to, vote in an educated way on these changes. But that's a big part of what the DAO will function as, and we'll continue to have LedgerWorks as a risk management provider that gives informed information about what the right way to do this was. And so yeah, that's sort of been our view on risk sort of from the beginning.
Well, I think this is a good wake up call to remind people that there is risk out there. Like you said, I think we are going to get stronger. I'm not going to tell anybody what they should do, but from my point of view, I am supplying liquidity on Bonzo. I'm going to keep that there. I'm actually going to be using that today to borrow some sauce. I used it just last week or a couple weeks ago to participate in Karate Combat 52. That was fun. Maybe we could talk about that here in a little bit. But again, I think it is a good warning call that, again, there is risk in this space, and we do have to consider that. So, Brady, why don't we? I appreciate you going through that and covering it in some depth, but I want to get into the metrics again this week. So, can you run through that?
Yeah, let's jump into it. So, to kick things off, DeFi TVL, it's such a key performance metric with regards to the health of the DeFi ecosystem. We did see a bit of a drop in US dollar value of DeFi TVL on Hedera. Part of that, I think, has to do with the prices in general. Just the market has been pretty volatile over the last probably like 4 weeks now.
Yeah, I'd say most of it, right? Most of the pullback we've seen is just the token prices dropping.
Yeah. So we definitely saw a bit of that. I do think with the recent sort of exploit, there definitely is a little bit of fear, and probably for I don't want to say a good thing, but it kind of is a reality check in a way where it's, yeah, you know what, these are DeFi protocols. At the end of the day, nothing is 100% secure, and it is good to sort of manage risk effectively in how you're participating. So I think that may have had a little bit to do with it as well. But we did see a bit of a drop. And then we look at monthly DEX volume. We really peaked in December and started to come down a little bit. That's pretty normal, I think, when you have such a blowout. I mean, I don't think there's never been that much volume in Hedera DeFi before, and so pretty expected that you're going to see a bit of a drop in that. We'll see what happens this month, but yeah, a little bit of a drop, but still high though. I mean, it's still, even in January, it's been one of the highest months, probably the second highest month in all of DeFi history on Hedera with regards to DEX volume. So that's great to see. Stable coins. It's been a weird last month for stable coins, actually. So looking at stablecoin TVL, so total value locked of stablecoins, and again, USDC is sort of the native stablecoin asset that everyone's sort of rallied around on in the Hedera ecosystem. We're still looking strong. It's, arguably the highest it's ever been in history with regards to total value locked of stablecoins. It's around 8 million. We did see a bit of a drop in USDC. As you can see here with Saucer Swap, we peaked and then dipped down a bit, but still overall up very much so. And then Bonzo stayed pretty consistent with regards to USDC liquidity. We've seen ups and downs, but overall since the beginning of January, it's been continuing to rise slowly. So that's been good. And then stablecoin liquidity, in terms of sort of the month being a bit volatile, we saw a huge influx of stablecoin liquidity where it popped to like $70 million in USDC that is considered active in the ecosystem. So USDC that is outside of the Circle Treasury account. I learned a lot about USDC actually the last couple of weeks with regards to sort of Circle's processes. What I learned was that in Circle's treasury account, they actually keep an arsenal of pre-minted USDC. And when you look at that account, there's around 250 million, or it appears to be 250 million of USDC in that account. And it's easy to sort of misconstrue that as being like, oh, that's USDC liquidity that's backed by US dollars that's on Hedera, when in fact, part of Circle's optimizations is they actually just keep a pre-mined treasury that technically is not considered active in the case of people coming in and wanting to provide US dollars and receive USDC from Circle for whichever network. And to give like an even more extreme example, if you look at like Algorand's treasury for USDC that's pre-minted by Circle, I think it's at like $3 trillion or something like that.
That doesn't make any sense. I mean, I understand, a few hundred million, but to have multiple trillions of dollars or a significant percent of M2 already minted doesn't make a lot of sense, in my opinion.
Yeah, I was a bit confused by that. I mean, they have very like strict administrative controls. So for Hedera, that means using the token service, having an admin key for the asset. It's a multi-sig threshold, and then their ability to freeze accounts that have USDC in it, or freeze the USDC within accounts is possible. They can pause transactions. They have a lot of control actually over the USDC that's issued on really any network is how it's set up for them. And so while I agree that having that much like pre-mined USDC in the account is risky, they also have so much ability to kind of do whatever they want with the USDC. So it's a lot less permissionless, I think, than maybe it appears on the surface. But I do agree with you. It's like, what's the point of that 3 trillion? Yeah, it seems absurd.
So Brady, this spike that we saw where it doubled from about 34 million where it returned back to 70 million, that shouldn't have had anything to do with that like pre-mined Circle USDC that you were talking about. This should have been something else. Do you have any insights as to what it could be? I saw, rumors floating around out there that there might have been some mentions of Aberdeen in the metadata. I don't know if there's any accuracy around that. And of course, that can lead you down the wrong path sometimes when you're trying to do analytics on this kind of stuff. But do you have any more insights as to why we might have seen this spike?
Yeah, so right. High levels of speculation and rumors, and it's really hard to know exactly what it is that happened. But in looking at the on-chain data, it does appear that 30 million of USDC or around that was minted and subsequently transferred to an account that contained assets that appeared to be labeled for an Aberdeen related fund. And most likely that's through ArcX Crypto, who's sort of manages that for Aberdeen. There's a partnership between those two parties. But there was, an asset that was sort of a Aberdeen fund that was in the same account that the USDC ended up being deposited into. And then it looks like the USDC went there and then exited somewhere where it was not considered active within the Hedera ecosystem. And it's really hard to tell what happened, to be honest.
So it's a mystery at this point, but certainly some interesting things going on.
Certainly interesting. I'd argue that more activity is better than no activity. It's
Sure.
possibly indicative of something that's coming related to, ArcX or Aberdeen. Again, I'm just speculating here, but we have been waiting for a while to see sort of what pans out with regards to, that use case and that integration. And so maybe it is indicative of something that we might start to see happen related to that. But time will tell. So moving on to our last section with regards to metrics of staking. So liquid staking with HBAR X through Stater Labs, and then native staking through the Hedera network itself. The liquid staking APY with HBAR X is sitting at about 5.76%. So, folks who are supplying HBAR into Stater Labs HBAR X liquid staking contract, they receive HBAR X in return, and HBAR X has this inherent yield whereby it's sort of realized when you unstake HBAR X for HBAR, and it's a healthy percentage. But I think, again, and not to create FUD around this, but again, it's a smart contract based activity, and it is technically in the DeFi ecosystem, although it is, it's staking. The way that the mechanics in which this is sort of approached is through smart contracts. And so I do consider liquid staking, part of the DeFi ecosystem when we talk about risk. Thankfully they've been great partners. They've been established and around for such a long time, obviously rigorous audits and everything. And so they seem to be doing things right. But it definitely falls into the DeFi category. And then native staking, sitting at 0.082%. Still lots of rumors around maybe there potentially being an increase in the native staking APY to compete with other networks that have that set a bit higher, but nothing concrete from what I've heard. I don't know if you've heard anything else or any updates on that front.
I haven't heard anything in particular. I'm hoping that, with the focus on retail from Charles, we could see that. It's those two different buckets, right? If you're putting 20% into various DeFi things like state or staking, the rest of your portfolio, that 80% that you might have in HBAR, you probably should get some kind of a reward for that, for providing that capital into our ecosystem. But we'll see what happens from it. But Brady, I want to get into some of the other things that I participated in. I mentioned that I borrowed a good chunk of karate, and I had a pretty good outing during Karate Combat 52. I was actually pretty shocked at how little I had to pay in yield for that. Can you give us any insights around that?
Yeah, so we put out a report for the first event that took place with karate, and sort of what the impact was with regards to the karate market on Bonzo Finance, and the APY rates and utilization was really, really high. We learned a lot from that and had set the risk parameters a bit differently, the interest rate models a bit differently to account for the behavior that we saw. What happened this time around with regards to the karate market is if you went and observed, in the analytics for that asset, what took place, it didn't spike the way that we saw the first time. And the details are kind of interesting and important here with regards to that. So the karate pool on Bonzo Finance, all the pools have supply and borrow caps. And specifically for the borrow caps, the way that that's configured in Bonzo is you have to set it, and Aave, you have to set it as an amount that effectively is a token amount. And it can't exceed the amount of tokens borrowed that you've set for that. The thing is because it's a token amount versus a percentage of the total supply, if supply is removed, then that token amount ends up actually being way more than what the originally sort of anticipated percentage was. And the first time around, what ended up happening is many people removed liquidity from the pool, so much so that the borrow cap really wasn't effective. The borrow cap was like higher than the amount of supply that was actually in the pool because of people removing it so fast, and so there was no sort of throttling um, ability there, or cap ability there. This time around, less people actually removed liquidity from the karate pool. And so the cap actually served its purpose of preventing more borrows. And I think we even talked from the side, and you're like, yeah, I couldn't borrow anymore. And so
Yeah.
unless tons of people remove liquidity from the pool, then you're going to see that where effectively it's just not going to see the spike in utilization that we saw the first time around. And so, I mean, it worked as intended, but it limited users from being able to really push the envelope on borrowing to utilize it. And so we're still learning on it. I think maybe this means the supply cap should be a little bit higher next time. It's hard to predict
Yeah.
how much of liquidity is going to be removed for these events, though. And I'd argue it's better to be safe than sorry.
Sure.
So yeah, definitely a good learning experience, but this time around, a lot less excitement for sure.
Well, I'm just going to keep doing it until it doesn't work out. I don't know what, I paid exactly and what I earned on it, but I know I earned an awful lot more than I paid. So I'm going to keep doing it until it stops working. But it's been fun to use so far. Do you have any news items you want to go over?
Yeah, so a couple updates from across the ecosystem for Bonzo Finance. We're continuing to push forward on the various milestones. We're still such a young protocol. We've really only been around for a couple months now, and the next milestone that we have coming up that's related to decentralization of the protocol. And the first thing that we kind of need in order to be able to establish the DAO is the governance token being available for users. And so, that event is called a token generation event, or TGE, and we're confident about a February date with regards to that. We don't have a specific date yet, and really at the end of the day, for us, it's about ensuring that all of the activities related to achieving that milestone, we're doing so in a secure way. One of the examples for that is there's a token claims process for folks who are community members, NFT holders, and there's contracts related to token claims. And so ensuring that those contracts are working properly, we're going through audits with Halborn, and those were just completed, and security is just top of mind. And then also just ensuring like the user experience. We've seen like past projects or events in the past in the ecosystem where when you have just a large number of people that are all trying to do the same thing at one time, it can overload things. And so trying to stress test in our testing to make sure that we have the capacity to be able to facilitate that influx is really important as well. And a lot of times people, when they think about this type of milestone for projects, I think it's really easy to think like, well, it's minting a token using the token service and then setting up a liquidity pool in Saucer Swap, and then like you're done. And for our community, we tried to be as transparent as possible in Discord, and listed out like every single activity that's involved in this, not just by Bonzo Finance Labs, but there are also other independent entities that have their own sets of activities that they need to do in support of this milestone separate from us. And it does include, things like liquidity provisioning and listings, various marketing activities, things of that nature. And so, yeah, so we've gone down that path, and we're in a good spot for February. And so we're really excited about that. And then the other thing, I mentioned like a big influx of users and being able to handle capacity. We recently migrated to HGraphIO's services. They are a big infrastructure provider for the Hedera ecosystem. They've been around for such a long time. Brandon D and Tyler are sort of leading the way there. And then, previously, I think it was Patches that was kicking things off for HGraphIO originally. And when we switched over our mirror node services to their hosted and managed mirror node, just massive speed increases. We didn't run into the throttling or errors that we were seeing with the sort of Hedera provided mirror node. And it's been such an amazing experience. Their team is just on top of it and always awesome. They're doing some really, really cool things related to not just like infrastructure for applications and wallets, but also in the realm of data. So operating an indexer that uses GraphQL to be able to get data from Hedera very quickly and efficiently. Really bullish on everything that they're doing, and really love their team. They're incredibly supportive. The next thing is, Dovu. I consider Dovu, part of the DeFi ecosystem. Absolutely, they have a number of DeFi focused activities for folks to use with their native asset, and they have announced updates with regards to Dovu OS recently, and in particular their usage of the open source Hedera Guardian, which is like effectively like a carbon credit issuance and management software that is heavily being pushed and utilized by the ecosystem on Hedera. I think that category of DApp has they've done such a good job of growing that out and establishing Hedera as like the network if you're going to do carbon credit related applications with the Guardian. Hedera's network is really well set up for that. And so they did a stress test on testnet of 1 million carbon credits just to prove out sort of velocity and usage. And so definitely go check out their X page has some information related to that test and all the other exciting updates that they're doing. And we're really proud of Dovu. They're awesome.
Good stuff. And you're heading out to HederaCon, right? You have some news on that?
Yeah, so I'll be at HederaCon, and two other of our team members, our co-founder and CTO, is going to be there, and Renly, who's leading our marketing community efforts, she's going to be there. And what's awesome is that they tied HederaCon to ETH Denver this year, so it's taking place obviously in Denver and towards the middle of the week for the ETH Denver event. And I keep seeing posts by a number of prominent folks in the Hedera ecosystem and outside of the Hedera ecosystem too that are going to be presenting at HederaCon. So we've got folks from Reon or previously Wallet Connect that are going to be presenting at HederaCon, which is really cool. And then also Chainlink, I think, is going to be on a panel as well. And then tons of ecosystem projects. Bonzo will be on a DeFi panel. So lots of really exciting stuff, and it's awesome that we're gonna be able to get the community all together in one place and have a good time and talk Hedera.
Yeah, it's going to be fun. I'm going to be moderating a panel talking about Hedera history, and there's going to be all kinds of great panels, all kinds of great speakers. Next up, you have some information on Axelar as well, right?
Yeah, just a small update. In the last DeFi corner, we talked about Axelar sort of going live soon. Really excited about Axelar as a cross-chain asset bridge for Hedera because this is really going to enable the ability to siphon liquidity and bring on new users from other chains into the Hedera ecosystem and grow this out. And no promises on dates. It's always speculative here, but the target is starting to look a little bit more like March. So really excited about that. And in particular, some of the mechanisms that they have specifically for Hedera native USDC and bridging USDC from any other network onto Hedera and having it show up as Hedera native USDC is really important, going back to the stablecoin TVL metrics and liquidity metrics. And we'll be running some incentives with regards to the market for Hedera native USDC on Bonzo. Lending protocols live and die by stablecoin liquidity. When you look across the board at their ability to become economically sustainable from a revenue perspective, stablecoin liquidity contributes to so much of that. And then it also enables all of these different DeFi strategies that you otherwise would not be able to do with a lending protocol without stable assets. And so for us, it's just like a cornerstone, most critical thing. And so anything that allows for greater accessibility of stable assets on Hedera, we're all for and excited about.
Absolutely. All right, Brady. So we do have a lot of good things to look forward to. We did have some hiccups, obviously, this week that we're still trying to work through. Is there anything else you'd like to pass on before we let you go?
Nothing else for me. Agreed. It's been definitely a wild last, I think, few weeks, month. I am really excited about HederaCon. I hope the community is able to meet all of us out there, and yeah, it should be a good time. Appreciate you having me on.
Absolutely. Now, I do want to also thank you for toughing it out today. I know that you got no sleep last night as you were trying to wrap your head around all this, so we appreciate you taking the time. I want to give a final plea to whoever took the funds that you can get on the right side of history here. Put that white hat on and return those funds, and I'm sure there'd be a pretty nice bounty in it for you for finding this exploit. But that's pretty much all we have. Brady, we'll see you in a couple weeks.
Thanks so much, Brandon. Bye.